This video is going to be on my experience and observation using RTH DVA. And this is the third iteration of this type of video that I've done. I knew whenever I was transitioning to RTH, it was going to be a process. And so I had these distinct check-ins, which I would kind of redefine how I understand it. And this is really a learning tool for me, but I put it out to the community in case anybody else is looking to shorten their learning curve or even just piggyback off some of my observations. So let's talk about my experience using it. I've been using it for about 8 months daily. I've been observing 2 or more markets pretty much every day using the RTH DVA. The first 2 months of it, I was using ETH and weeklies to help me kind of filter it down a little bit and get an idea of how it behaves. But in the last 6 months or so, I've been using it exclusively as my intraday filter. No other time frames. That's my intraday outlook. It's RTH DVA. So let's talk about just some generalities with DVA and RTH DVA. RTH stands for regular trading hours. This is the cash session for any given market. In other words, the high volume, high liquidity session of whatever market you're dealing with. But before I dive into like specifics on RTH DVA, I kind of want to talk about like why I'm focused so much on DVA in general. I think the DVA is kind of this core and key component that it takes more experience to learn how to read it. It takes more time and observations to learn how to get good with it because it's more of an art than it is a science. An RTH session, I think, pushes that one step further. So let's talk about some of the 3 things that DVA accomplishes for us and helps us filter with market-generated information. The first thing it does for us is it defines a condition. It gives us an idea of whether or not we're rotational or we are trending, right? So that's important. The next thing it does is it defines opportunity. In other words, it gives us levels that we could trade from in specific, repeatable types of trades. The third thing is that it provides pattern recognition, but specifically volatility adjusted pattern recognition. That's important. So each one of these ideas kind of builds off of each other to kind of develop the full picture there. But essentially, DVA is super important because it gives us repeatable, volatility-adjusted ways of filtering market-generated information. So then why did I start using the RTH time frame specifically? Well, my reasons really started here. I had some personal trading deficiencies that I wanted to basically slap a Band-Aid solution on. In other words, my trading was inconsistent. It was impulsive at times, and I wanted to find some quick fix for that. There wasn't one. But it turns out, by switching to RTH DVA, I started to do the real work in learning how to read the intraday environment, and I got way better at it. So making this change, even though it was just a quick Band-Aid fix, forced me to start really doing real work because I wasn't getting information from other traders because not many traders at the time were using it. So my first problem was I had pre-market and morning inconsistency. I also thought that ETH offered fewer opportunities and it gave me higher anxiety. I was inconsistently applying ETH DVA. In other words, I was inconsistently reading what I was seeing with the ETH DVA. My biggest problem was inbounds pullbacks, being able to really tell which one made more sense than another. One of the other problems I had with it was ETH VWAP. My problem wasn't trading from VWAP. I think that's an easy thing to do. You just mark it on your thing and just don't trade from it at all. And there's a simple solution. But my issue with that is it's insignificant then. Why even have it as a level, right? If it's a place to avoid, don't even use it. And that was always a kind of a conflict within my own brain. And this was really the crescendo of all of my problems using ETH. I had a hard time defining intraday pattern. That, for me, was a big issue. I was okay with my narratives and building that stuff, but whenever it came to seeing strength and weakness intraday, I had a really hard time defining those patterns, especially in rotational environments. So let's talk about some considerations of RTH by itself. This is now not me as a trader at that time. This is me talking about what RTH has going for it or against it. First thing is time. RTH requires time to develop. I say an hour is the best rule to use. You should wait about an hour before you start using it in a session, especially if that session is a little bit more high volume, a little bit more volatility and things like that. If it's lower volume, lower aggression, things like that, you could probably use 30 minutes and get away with it. But I was going to say like a hard rule is stick with 1 hour and even let that go to an hour 30 and you can start using it. Problem with time is that it often leads a trader out of the opening movement, the opening drive. So if you're somebody that really likes that opening movement and you're somebody that trades it well, RTH DVA can be a problem. There is a solution though. You could use ETH or a weekly DVA to substitute all the way up to that hour 30 into a cash session and then switch to an RTH DVA. That's a possible solution to this time issue. VWAP. Unlike ETH DVA, VWAP reference has more significance and more implication for a given market and the intraday bias. It's not a level to avoid, it's a level to watch and see how the market reacts there, because that can give you an inclination of a pattern in an environment. The levels, I think the deviation patterns are a little different using the RTH. I think that the best deviations to use for RTH are the first, the second, and the third deviations, the 1, 2, and the 3. It is the same concept as the 1, the 1.5, and the 2. I've just noticed that the 1, the 2, and the 3 tend to behave better and tell you more information on the RTH session. You can always add more if you want them. The final thing is behavior. I think RTH can behave differently in different markets. I think that crude in a rotational context will tend to push extremes further. For example, I think crude in a very rotational type of day could push the second deviation very, very regularly. Whereas a less volatile instrument like the ES or the Ultra Bond could usually rotate within the first deviations, and we would define that as rotational. So one thing about this particular consideration is you need to really be systematic and observe it for some time in that given market before you start trading with it or making any generalizations at all. This is more like, take the time and experience the RTH over a considerable period before you start applying it. Really look at it and see what works best for your market. So some of the clear benefits of RTH in my mind, right? I think that the line in the sand idea that is a general rule, in other words, we're bullish above, bearish below, is more significant to an RTH, VWAP line. I think that there's more opportunity in terms of patterning with intraday rhythm in the RTH DVA. We'll see that maybe a little bit more in the examples I go over. It's more immediate here and now. In other words, what happened overnight doesn't matter to how it's developing right now. What matters with how it's developing is the moment the market opens for you and then to the development of where you're sitting there. So it's a lot more of like, who cares about what happened overnight? We're now looking at what's currently happening right here. It's also a lot easier to trade direct momentum using. It's a little bit more mechanical. There's more deviations in terms of levels. Well, not more, multiple, as in more patterns that you might see for you to be able to manage direct momentum trading a little bit easier. All four of these ideas really crescendo in generalizing it as better pattern recognition for myself, at least I think so, and it naturally adjusts to reading the short-term rhythm of any market for the current here and now. So let's define our levels. First level is VWAP. It's significant for defining the current condition, the here and now condition of what's happening, and reading the short-term rhythm. First deviation is a level that we use more for rotational extremes as a rotational fade for a slower market. It's also a level that we use to establish, trending environments, just like we do with ETH. The second deviation is significant for strong and rhythmic trends, but also is significant for more rotational behavior, wider ranging rotational behavior. So whenever the rhythm kind of changes, this becomes significant for rotational behavior. The third deviation, I consider this an extreme for price movement for any type of environment, whether it's rotational or it's trending. That third deviation is not a place where a market often stays for an extended period of time. That's the best way to kind of describe it. So let's define the basic price behavior that we might see with RTH DVA. Just like ETH, it has two clear price behaviors I see as trending and rotational. Whenever it's trending, RTH will often hold above or below the VWAP, and the direct momentum will often channel between deviations. So in a trending environment, we're holding significantly above or below VWAP, and we're going to have a pattern of channeling between deviations. In a rotational environment, price often carries through VWAP without much consideration for it and rotates between two deviations. Often it's the second deviation, could be the first deviation if the market's slower that day. It's important to observe the price behavior at the VWAP level because a lack of a clean VWAP rejection can kind of tell you that we're in a rotational environment. And we'll see this more with the live or the examples I have at the end. So let's take a look at different types of trends. The first type of trend I define is what I call two deviation trends. These trends do not regularly hold outside of the first channel. I mean, they can, but they don't often do that. They usually rotate between VWAP and the second standard deviation. And they will traverse a deviation in between, hence the name two deviation. So what you're seeing here is, this is our levels of deviation here. We traverse between two of them while we skip over one of them. That's a two deviation trend. So what you see here in the price action is what I consider a two deviation trend. This is a specific type of intraday rhythm that I monitor for and I use for trading decisions. What often happens with these types of trends is that they establish themselves with a wider range. Then something happens during the day where they transition to a new type of environment. So we have a two deviation trend here, and then we have something else going on here. So that something else is what I call a channel trend or a single deviation trend. A trend or a channel trend environment is a more aggressive type of price action, and they tend to hold outside the first deviation. These are the type of trends that don't really come back to test VWAP. They essentially hold outside, and they have more energy, more aggression, whatever you want to call that, behind it, more velocity even. All these things kind of align, and they define a trend as a little bit more, has more energy. And that's what you see here, establishing itself in between the first and second deviations. This is a pretty healthy single channel trend that we often see using RTH. So in this previous example, we went from a two channel trend and we transitioned to a single channel or one deviation trend. Let's take a look at some rotational ideas. In a rotational environment, price often crosses VWAP without much consideration or regard for that level. In this behavior, mean reversion is a critical tactic to have. However, there is a pattern that I've observed, which I call wide range rotational markets. And these tend to traverse three deviation levels. In other words, they have an origin point, and then they traverse three different levels to find support or resistance. So first example here is the classic rotational environment. This is what you might see in a slower type of day, where we have complete disregard for VWAP. Sure, sometimes like in places like here, we might hold below it, get a little bit of excess, but on the recovery back through it, we completely ignore VWAP again, and we maintain that rotational picture between these two deviations. In a wider ranging market, what you often see is price action that kind of coils up a little bit in between a channel or so, and then we get a larger release where we traverse three deviations, then we settle into a new rotational type of rhythm. This is a wider ranging market. This is a more of a normal tight ranging rotational market. This is just a quick example of what a theoretical market might look like in a rotational type of environment, where we start off, it looks like we're going to trend for a little bit, and then we start to see some weakening, and we get a bigger breakdown that traverses. So we go from like this, we might see a trend, to a transition point where we go to rotational. It looks a little bit wider. So a wider rotation. We get these nicer rhythms, and we kind of maintain that rotational environment for the rest of the session. So that's theory land, right? Let's take a look at some specific market examples. And let's kind of analyze from left to right what we're seeing in those markets, and then kind of how we see that behavior developing. So this is an example here that I picked out. I'm not going to tell you what market it is because it doesn't matter. What really matters is how the price is behaving with the RTH DVA. So let's give it some time to develop. Let's say this is about an hour. And the first thing we notice in that hour, we have maybe a rotational context. The VWAP isn't really respected. We traverse from the second deviation to second deviation. So VWAP, first deviation, second and third up here. So we get that kind of full rotation. It looks like we might end up rotational, right? But then we get some information that kind of contradicts that. We get 2 VWAP holds, a rejection at the second standard deviation. So what that tells you is we're settling into a 2 deviation trend. We see the rotational extreme here. We see the VWAP hold here. The trending environment holds. Then we get a pattern shift here, which is important because something changes in this market where we start to hold a single channel trend and continue on through the day. So right here is where we get a transition from a 2 to a single channel trend. This is one of the benefits, I think, of RTH DVA. There's more of these types of pattern shifts and more market-generated information to use during a session to really analyze how that price and shorter-term rhythm is adjusting to the market as it develops throughout the day. Let's take a look at something that totally changes condition, right? So give it some time to develop. We analyze that a little bit. We see a VWAP hold here, but in that VWAP hold, in a normal 2 deviation type of trend, we would expect to see price come down here. Price doesn't do that. It holds here. So this gives us an inclination that we're probably going to see a rotational environment. That first deviation holds. We get up to our first extreme, come down, little pullback, go up to our next extreme. I still think this is rotational. I still see this as mostly rotational. Only because we ignored VWAP completely. And look at the rhythm. Look at the rhythm that's occurring here. We got a little bit wider ranging rhythm occurring. This market could easily go from the second deviation down to the first or the second again. And that's what we end up seeing in this particular leg down. We see a nice full rotation down. We get another full rotation up, another full rotation down. We start to see the pattern shift of it's starting to look a little bearish, right? We get a hold here, continuation to the upside, and now we see a failure of that bearish edge here. We start to hold bullish right in this section. So all through here, I would say this market, I would define it as rotational. And then something happens. We get a transition right here. This market does something which we would define as what? Nothing. It doesn't have a definition. That's important. And believe it or not, that's something that I've learned to really embrace in the RTH. Sometimes you get market moves like this. And what this does is it acts as a transitional period for a new pattern that you can use later. Specifically, we got bullish information in this uptrend. A lot of energy was put in here. A rotational bearish outlook failed. And we got bullish in this area. And then what happens? We transition to a single channel trend. That kind of information is one of the main reasons why I've stuck with RTH DVA and I use it on an intraday basis. Let's take a look at something else. Kind of similar to what we just had there, but a little bit more energy in this market, right? I think we can all clearly define this as rotational. We're bouncing in between extremes. We have a nice clear pattern there. VWAP is pretty much being ignored all the way through it. Then something happens, right? We get a piece of information in this section here that acts as a transition where we don't have a nice clear definition for the pattern that we're seeing there. But we do have information. We have bullish price action. Looks like it's high energy because we're outside the third deviation here. that type of energy possibly could see some follow-up. What do we see out of that? Single channel trend for an extended period of time. And then we get a deeper pullback off of a pattern shift or a failure here back into the range. Just another example, right? So different market, different type of price action, but the RTH pattern still kind of holds the same. Give it some time to develop, right? First thing I notice is a VWAP hold. Close to a push of the second deviation here. Not quite. So maybe not a high energy type of down move. But the VWAP held, so we're generally bearish. Come back up. VWAP generally holds. Comes down to the second. What happens again? VWAP holds here. Definitely from here to here, you could probably define it for sure as a two-channel trend. 100%. So this would probably be a great opportunity for you, depending on what you had going on with your narrative and things like that, as a level that you could trade off of, especially after seeing this information here. From there, we kind of transition to something that we don't define right into the close. And what this really more or less is a pattern shift. And we head back into mean reversion and we go rotational after the fact. Final example, let's just kind of beat this dead horse and make sure that we really understand what we're seeing here. Give it a little bit of time to develop. We notice some steep price action here. And then what follows, a little bit of a rotational environment for sure, I think. I define it as rotational. I see this VWAP not really holding much. We're kind of going back and forth through it. We're pushing extremes on the first deviation, kind of a low volume, type of rotational environment. Come back up. I think expectations are good all the way up into here, where I think there's a transition. And to be honest with you, I think the transition is pretty much from here to here, because we hold VWAP here and we hold VWAP here. So we're transitioning to a new pattern. But what do we have? We have bullish information. So the expectation from there is that we might transition to something more bullish. Another VWAP hold here. Then what happens? We take off. We create an aggressive type of trend, holding outside the third deviation, which is important. So we see a deeper pullback coming out of that. Opportunity to fade, sure, but also opportunity to look for a two deviation trend setting up, because the energy put in on this up channel, on this up move, will probably traverse a deviation in a pullback because it's going to be a little deeper. And then we settle into a little bit more of a different pattern. So these are just some observations of my experience in using the RTH DVA. It's okay to have a section of RTH where something is shifting and something is changing. That is information. It is market-generated information that we can use to better make pattern recognition later, to better make our trades. For me, this is the most important aspect of why I use RTH DVA. Those type of transitional moments during a day where I say, oh, this isn't making sense anymore. Those are where I look for opportunity, especially opportunity that aligns with my narrative and my pre-market prep. So hopefully this was helpful. Have any questions, anything like that, let me know. And keep trading well, and we'll keep developing, getting better.